You're listening to Fund Shack. I'm Ross Butler, and today we're talking about private markets entrepreneurs, emerging managers, new firms, new strategies, how private capital innovates and reinvents itself, and whether it can do for itself what it facilitates in other sectors, which is to be transformative and adaptive and receptive to emerging opportunities. And here to discuss this with me, I'm delighted to have Kim Pochon, Global Head of Primary Investment at Unigestion, and Joe Briggs, founder of BCF. Do I have the word right here, emerging managers? I'm not 100% sure actually what that means. What does it mean to you, Kim?
I think in our experience, emerging is a misnomer. It's really a misnomer because I think when the quality of the people that we meet, the people that are setting up a new fund, I think in our portfolio, average age, late 40s, maybe sometimes 50. So quite a lot of experience. So these people are definitely not, people just graduating from the university and starting to invest the money. These are very experienced people that have seen many cycles. And often it's quite funny because that's probably the first thing is to test a bit the ego of these people, because you have someone from a blue chip private equity firm spinning off, having the first meeting, and then when I discuss a bit what we do, that we would see them in our emerging manager bucket. Then that's the first time you test a bit the ego, because some of them, they may be 55, working at blue chip firms and being labeled as emerging. A lot of them, they laugh. They smile. Some have a bit more embarrassed smile. And that's the first way to test a bit the ego. Yeah.
It's also, I get the sense that they don't really identify with it. Even very experienced managers, they don't sort of walk into the meeting and say, "Hi, I'm a future brand name manager," or "Hi, nice to meet you. I'm an emerging manager." They say, these are the exceptional things we've done in our past. This is the exceptional opportunity we're going after, and this sort of ecosystem of it is helpful. And I think it does have a really interesting definition when you think about how LPs sort of structure that. So and a really essential question for GPs of just, do you fit that? So are you viable for that program? That is something to pay attention to, but it's a label that attaches there. And then I think it's one that just seems to exist in a sort of service provider sales community where it's sort of a way of kind of packaging an activity that individually as these managers are just sort of, they do spend, and they should spend time in that community with other GPs. It's an essential part of how you learn the process, but it's not something I think that is being identified with, or should be given too much. Too much sort of emphasis on their own side.
Yeah, we kind of got to call it something, but nothing's really right because first-time managers isn't quite right, and they might not. It might be a second fund.
Mm-hmm. What are you going to call the Fund Shack series? Is it still going to have an emerging manager?
New established managers.
I think emerging is fine, but
we're going to have to use it. I think sometimes you just got to go with it.
Yeah.
Kim, where does your interest in emerging managers come from? Yours and Unigestion's, of course.
Again, I think when I joined Unigestion, it's been just a core part of our DNA of what we do. So I think I've always been into that mantra that innovation, alpha, good returns comes from emerging managers, and it dates back actually from the early 90s when we've been one of the pioneers in private equity, in primaries. So for instance, a couple of people that are still today at our IC, very important. So for instance, Bernard, our chairman and founder, he was investing the money of Unigestion in the very first private equity fund. So we've backed, back in the days, the very first funds of EQT, Cinven, the first European focused fund of Carlyle, Francisco Partners, Silver Lake. I mean, you name it. We've been in these firms when they just started. And of course, we followed this firm for quite some vintages. But again, we are a global low and mid-market specialist. So I think at some point, when these managers grow too big, we just left them. But we always kept investing into the new emerging managers coming to bring something novel to our LPs, to our portfolio. Is it a new sector focus, a new something around value creation that is new? And actually, 40%, so 40 of everything that we have done in the firm was linked to emerging managers. So I think it's really a core part of what we do. And then it's just bearing so much fruits also that we're still harvesting today. For instance, we just have also with our secondary fund. Now we're doing secondaries, GP-leds with the emerging managers that we backed 15 years ago, 10 years ago, that are now established. And now we do versus continuation vehicle with them. So what we call our graduated emerging managers, basically it's a very good part of our deal flow for on the secondary side, or the co-invest side, of course, as well. So we see the long-term advantage. We still see that, and we continue today. We have a dedicated program to back them. So now it's not like a sub allocation of our traditional fund of funds or the program. It's really a program itself to give direct access to this segment.
Do you think you have a different relationship with those managers as they become established because you were in at the start?
Of course, it's day and night right. In the sense that you have a very deep relationship when you give them a phone call, drop them a quick email. They're always responsive because I think a lot of them, they show a lot of loyalty that we've been there in the first place. Even some of them now, probably we did not re-up in the latest fund because they grew very too big for our mandate, right. For instance. But we still have a very good working relationship. I know some, let's say, founders or let's say managing partners that are now probably new LPs can have 15 minutes with this person or a very small call. And me, I still have the direct phone number, so I can still even text message to this person and get instant feedback. So it's quite valuable.
I guess that must really resonate with your own investors, right? In terms of that heritage doing this, but also that you your own track record in that. And it's interesting how some significant pools of capital and first-time funds raised in the last few years to go after brand new strategies or set up new managers that want to back emerging managers, and increasingly also could maybe take a stake in a way. I know you guys don't, but the sort of seeding of it. So it seems like it is increasingly a more competitive fund-of-fund environment for this activity. But I guess you, having done it for so long, will always be able to sort of have an edge over sort of some of the newer offerings, right?
Yeah. No, of course. I mean, we always try to be the first phone calls when something new happen, because it's true that you don't have, I mean, especially in Europe, you don't have a lot of go-to LPs to give, to be there in the first closing of a first fund. You don't have many of them.
So we got two experts talking to each other. When you said you don't take stakes, so you're saying that a lot of first-time LPs and it's first-time funds, they take a stake in the manager itself.
Yeah, I think that is one where this sort of, when you think about the evolution of asset classes we were discussing in terms of different specialisms, this is one where investors are increasingly aware that there is an interesting asset class at play here in not just commitments to funds, but in owning a piece of these managers. For me, you've got to look at it in the context of what's going on with the larger groups in the GP stakes context, where just these types of transactions are just more prevalent. The idea of owning a kind of having the external party owning a stake, and so the various different structures around how that's come through just means it has just become more familiar territory. But also that kind of underlying pitch to investors that where you're saying there's access here to interesting new managers, but also to a bit of the franchise, a bit of what they're building, a sort of different touch point essentially into that ecosystem that I think has more often, I think the groups that are setting up new emerging manager fund of funds, that is a key sort of mechanism or a key sort of piece of what's on offer, partly because it's, I think, also just a bit more on offer than it ever was. There's always that tension there around, is it actually something that's a good thing to sort of go and give up? If it's the right strategic partner and they're bringing a lot to bear. No, if it's a group that maybe hasn't done much of this before and is sort of just actually saying, well, this is a condition of us helping get you a fund together, and maybe it's too big. That's an obvious problem. Yeah. It's, it can do plenty of things that can go wrong at that early seeding stage that actually just mean that the prospects of third-party capital are actually reduced.
What proportion would you say of your clients that offer that?
I think right now, a brand new first-time fund that's not a sort of full team lift out and that is absent sort of already anchor committed capital or hasn't already been doing a lot of deal by deal investing, it's on the table, and it's not so much that they should be promoting it. So like, hear our pitch, and by the way, you can own a bit of us at the same time. Yeah. It's more that they should be aware that it is a topic of conversation that is relevant to them, and at least have a very thoughtful answer to the request that comes in, or have thought about what it would mean to, offer up a bit of a contractual revenue share,
or
fee
how
and
to
carry.
say no politely.
Yeah, or just why it is on the table, why it isn't, why why it has to be done like in this certain way.
Yeah,
I've done quite a lot of the structuring at this sort of stage, and often you get funds that have never been through a sort of GP seeding process before, and also LPs that haven't, coming up with these sort of interesting ideas for, okay, what's the right construct there, and not getting the right advice in terms of things that are just non-negotiable for sort of any third-party institutional investor looking at that construct.
Yeah.
And so just a real sense that they've been thoughtful about it, they've taken the right advice, got the right sort of legal input at that crucial stage, because it's part of the setup of the management company at the end of the day.
Kim, is that not something that you currently look at? Is there something that you're...
No, so I think, again, taking a stake in the management company of emerging managers, I think that's, again, it's not core to our strategy. We don't exclude that, but it's not core to our strategy. Because, again, I think it all stems that we have a 10-year investment horizon. And to be honest, from a pure return perspective, having a 10 years horizon, you need more patient capital, I think, to have that. So all the seeders that we know, and actually we are quite a good partner, actually. We partner quite a lot with these firms also to exchange names and ideas. I think all of them today, they all, maybe except one, are headquartered in the US. So it's still a US buyout play, but some of them start to also invest in Europe. But again, it's not that we just don't like it or don't believe in it. It's more the investment horizon. You need a very long investment horizon, in our opinion, to make it work. Because, of course, it's not a GP stake in a very established firm with a couple of, funds, good stream of management fee. No. It's really, it's really pure primary capital to get them off the ground. And of course, it takes a bit more time to monetize such an investment, in my opinion.
So the benefits to the wider ecosystem of emerging managers is pretty clear. But what tend to be the motivations of individuals to set up new management companies? Because working in private equity is pretty lucrative. You've got quite a lot of freedom and flexibility. By all accounts, it's a pretty rewarding job. When people come to you with a proposition, what tends to be driving them? Are there any common threads?
Well, maybe if I start, I mean, they all are, of course, different reasons to spin off. I mean, a lot of them, it's really the entrepreneurial call to really, want to build something for them, to make it their way, and also to find, again, sometimes they have also some frustration at their previous firm. They want to do smaller deals, or they want to do deals just only in one or two sectors. They go independent, they can do that. But I think a lot of them, I think what I see, still the vast majority, I would be curious also to see what you have in your clients, Joe, but it's really to have more this more entrepreneurial freedom to build something the way they believe is the best from the start. Because a lot of these investment professionals, as you said, they have lucrative, let's say, compensation, and a lot of them, they leave money on the table. And here we're talking about, 7-digit, they leave 7-digit money on the table to set up something new. Of course, in the long term, maybe they will not make more, some of them, but at least they will be happy, because a lot of them, they're just not happy in what they do currently.
Yeah. I guess you could think of sort of push and pull factors, right? And there's always got to be the pull, basically. You cannot just be doing it because you're kind of, there's that frustration. So, and certainly it can be exclusively the pull. You can have every reason to stay and still go after it. And funds should be aware of that dynamic at play. They really need to make sure that it's clear that they're going after something. It can just be the classic, the inefficient markets or new markets, new spaces, things that are just exciting to them that they want to go after. And this is they want to build a firm to kind of do that. Or that they're just drawn to it. They always wanted to do something themselves, to be entrepreneurial. They've sort of seen how the ecosystem of funds has evolved and sort of sets, they're sort of thinking it's our time. And obviously the critical mass around the team element there, we're not talking just individuals, it's sort of that conversation, which is obviously quite collaborative and quite sort of an interesting one. I think some of the push things are interesting, and you mentioned a couple there in terms of just what's going on and certain of the frustrations. It's worth looking at it in the context of just how larger funds are evolving and the successful things they're doing in order to attract but also retain top talent. A lot of groups have quite successfully launched platform extensions or basically sort of emerging funds within established managers, right? There are new first-time funds being launched within platforms. And the way I see it, it's an incredibly effective way of retaining the talent, because it's an ability to say, look, you don't own this firm, you're never, and there's the question about how that progression might go. But there is an opportunity for you to lead on this strategy, and we're setting up this new strategy, and maybe they even transition across from the flagship. But it's an ability to say, we recognize that you want to make an impact that goes beyond your financial just benefit of being sort of investor out of this fund, and to sort of participate in this story in a different way. Where that goes right, you get these brilliant case studies, and they're all out there raising multiple strategies at the same time and having a great time with it.
Yeah.
Where it goes wrong, and I think the fundraising challenges is a big part of the context for this, because you're raising if your flagship's struggling and you have other ancillary strategies that were in play or in design mode, if there's a challenge on the main one, it's going to knock on in a bad way. And I think that is then you get these individuals who are basically frustrations around the way it's kind of things have been going, and in terms of that process, maybe that new strategy got pulled, or it didn't come together. You can bet there's a conversation going on about, well, do we just go ahead? Should we just do this ourselves? Like, why don't we just launch it in that kind of way? I think also a lot of conversations, particularly sort of post-COVID, where I think maybe certain firms just weren't managing things quite as well, in the culture of the firm or the return to work elements. There's a lot that played out over that period where people weren't launching. That's why I think you didn't see a huge number of new funds, because who would launch a new firm where you can't meet up your own team in person, let alone with LPs. But also this sense that we're going to build something different, and the culture is going to be different, and we're going to care for our employees in a different way, and we're not going to make all of those mistakes that them lot made.
A more caring private equity.
So it's a sort of but again, these are pushes of sorts, but you've got to also be more obsessed with the pull, be much more incited by actually just what are we going after rather than what are we leaving.
Yes. So, and they're the carrots that established firms can give to people that are discontent. Are there any sticks?
Plenty.
Yeah, but as I said, it's also costly to leave.
Yeah.
Because of course, depending on the vesting policy that you have on the carried interest, can be very punitive. You can be even completely wiped out. So depending on the circumstances of how you left your previous employer. So yes, it can be very costly. But I also know a couple of people that make this jump nevertheless, because they see the longer term picture to being something that they own. Culture is a big thing. Also do deals that the deals where they have a deep conviction that they really want to pursue with deep convictions, because sometimes when the firm grows very, very big, it's about deploying and making deals. Okay, 2x plus return. Okay, fine, let's do it. No. I think these are really people that are very convinced that they want to really pursue the opportunities where they believe we can make 3x above. Talking about buyout deals here.
Well, leaving money on the table, surely that's instant credibility, isn't it? You're walking into my room saying you want to raise money when you're coming from a strong position.
Well, it's not when maybe that could have ended up as a GP commit. That would have been nice. If maybe we could increase it from the 2%, otherwise. And I think that is part of the reality here, is it's maybe a frustration around the way deals are going and carry not being quite the same motivation, but it does mean that these teams maybe are absent some of the payouts that were a part of what it means to go and invest in setting up working capital, GP commit. It's still an expensive thing to go and do. So it's something that they've got to weigh up in terms of in terms of the right time, and again across the team, to people who are often all in very different financial circumstances, where there's got to be a real acknowledgement across that in the team of just like, what situation are we all sort of in and what's appropriate. And investors want to see that. They want to see that the people who are in the better position are in for more. Like, that's just what alignment means, right? It's just that it hurts equally if this goes badly, is a kind of important thing. And that partnership construct early on is just being always neglected. People are kind of going out, thinking about raising the fund. They've not thought about the dynamics between them individually and how some of that, from a financial point of view, but also just in terms of how are we going to make decisions when this goes bad. Inevitably, we get setbacks and it goes badly, or some of the sort of oversight there in terms of just like we haven't even worked out, certain really critical questions.
So you're an emerging manager. In my mind, it was just, you work in a team with a couple of people you get on with really well in an established firm, and now you're going to do it somewhere else. But presumably that's not always how it works. Maybe there's a couple of people coming together from different firms. Maybe there's just one private equity investor and there's some industrialists, and maybe they've never worked together at all. Is that sometimes how it works? And if that is, how can you get a sense of the team's dynamic, its track record, whether it's going to gel, that kind of thing?
Yeah, so I think what you allude to is in the P jargon, we call it like a first-time team, first-time fund. Because a lot of LPs, they say, okay, first-time fund I do, but never first-time team, because it's just new people coming from different backgrounds. They say, oh, it's a bit risky because it just came together. I think at Unigestion, of course, it's not 100% of our portfolio, but we embrace and we also, let's say, engage in this first-time fund, first-time team situation. But of course, the due diligence is more heavy, of course, on the references, on the work that we do. But I think it's a lot of good things come out from these groups. But of course, you need to assess the team dynamics the right way. So it's talking. Of course, it's a lot of referencing. It's also meeting them one-to-one, all together in a formal setup, in an informal setup. So of course the due diligence is very long. It's not like, okay, we meet and we start the DD and in 3 months you get our commitment.
How many times would you typically meet up with an emerging team before you make the commitment?
So the stats, at least the GPs in which we have invested, so the emerging managers that we have backed, minimum time of due diligence, 1 year minimum. Some, it's more also when we don't come in fund one, but in fund two, it's 5 years, 6 years. It could be very long, but I think to assess the team dynamic, and here I'm just not talking about the senior people, it's the whole team. So to talk about to the juniors, to the analysts, to say, okay, how do they behave, or just to ask, okay, do they have disagreements in the office? Or is it always between closed door? Or if you have a personal issue, would you bring this to them? Or so I think we have quite a structured interview that is not plain vanilla, definitely not. But we have some sort of structured interview with the different team members to try to assess these team dynamics. Because from an LP perspective, it's always very hard to understand what happens behind the curtain.
Yeah,
and I guess it's just the biggest risk early on, right? Which is, it's an existential one, not just, will they do great deals, or even will they get a fund together? It's, will this work? Will they stay together? Yeah. Will they get on? Will they also an ability to work together, and can they actually execute as a team in this sort of format? And that's why you've got to very early on have quite a lot just to show for in terms of, look, we're doing things. It might not, and getting a fund together is one of those things. If that's why having a first close is such a big deal in terms of de-risking that, because something must be going right in the team dynamic, but also earlier deals and things like that are, or just the way that they're building their firm that shows, okay, look, this is gelling, this sort of works in this way. But it's, I
think you need to really understand how can these people disagree together? Because I can tell you, in our experience, so the 30 years emerging manager experience of Unigestion, the funds that went bad, so it means bad like we lost money, so not the full money, but less, we didn't get our cost back. It was always the team exploding. And of course, very often on the back of the first investment or the second investment turning bad. Yeah. And they start to disagree, and then it explodes, and everyone goes in different ways. It's really, that's why now we have a very stringent focus on that, because again, in our experience, these are the bad experiences that we have made. And it was really always the setup. So I think, can these people disagree together? It's very important. And actually, the recent years with the very tough fundraising market that we have seen, that was also very tough, or even tougher for some emerging managers. I see it as an LP, as an allocator, relatively positively, because for a lot of these firms, I can tell you the honeymoon period was very short. You don't have your first close, but you already disagreed, went through many tough times, as opposed to maybe 10 years ago when capital was a bit more abundant, you have a spin-off and you spin off and then you can get $500 million relatively quickly, and then you start to invest, but you don't actually have this fact check that is very hard on you.
This sort of explosion reference, I think, is spot on, because I've always thought these things, when they go well, they are like rocket ships, right?
Yeah.
When it's aligned and the incentives that are at play, and the brilliance of just how when you've got that construct together, just quite what you can achieve with the build. They're phenomenal businesses in their own right to see it get into orbit. But it's the exact same kind of concept when things go badly. It's explosive. It's these things. The dynamics of play work in that exact opposite way around, which means you've got to test it. You've got to have proved that, okay, when that bit of the machine sort of does, there's a setback that basically means this moves, that we've got a mechanism to resolve it. We know how we all respond. We know our sort of red lines on certain things. We know how to sort of approach it. And it's one of the hardest things to kind of demonstrate, I think, for investors, because you've sort of, until you've had a setback, which you wouldn't want to will on anyone, but in a way, I kind of sort of say to groups where they are suffering them, I say, look, the way I saw you approach that sort of in response was so spot on, was really, really great. And they'll agree. They'll be like, yeah, we've sort of bonded in that way. And maybe the first deal didn't get over the line, or maybe an anchor pulled out, or something, something like that. And it's like, these are formative stages for these new businesses. So if they have a few of those, you can guarantee they're going to sort of be better businesses down the line.
Yeah. Sometimes at that early stage, there's no real distinction between strategic planning and practicing communicating your strategy, because as you communicate it, you see the weaknesses in it. And particularly if you never, as you say, had a falling out before, a reason to disagree. Is there any simple way of explaining the conflict resolution mechanism? Is it simply you've got to have a hierarchy?
I think it's a hard one, because I think LPs usually don't like key person risk. They don't want to rely on one person. But on the other hand, from a due diligence standpoint, it's easier to isolate who calls the shot at the IC. So it's always a bit this strange thing that I have experienced talking also to my peers, that you don't want to have a key person risk, but you don't want when it's too consensus-based, because you cannot feel who takes the decision, where is the decision taking place. So I think it's always the very thin balance that you need to. I think it's only through several interactions in different contexts and reference work to really try to understand how these people work together. Because again, from an LP perspective, you're in a different spot. I mean, you see them arguing or really really being in the formation. From an LP perspective, it happens behind the curtain, and we don't see that.
Yeah.
How often do you get a great deal maker and a great fund manager in the same person? Or do you need those roles split up within the team?
For any new group, you've got to have an element of both of that, I think, in actually across the team. Everyone's sort of occupying an element of those two roles. You're actively thinking about your pipeline, the deals, how to execute, but you're also building this business and thinking about everything else that's at play. And in a way, the fundraise exercise is a really big other part of what it means to build a business, because it's sort of what will actually get you there and get you executing on those deals. But there's obviously, every different firm comes together very differently. There's such different fact patterns that are at play, and just different appetites to do certain things in the team, and different propensities for it. And it comes back to just a real sense across the team of people's strengths and weaknesses, sort of that delegation of it. There's no set sort of team chart where you just need to populate this exact sort of construct, COO, IR, investment team, here's the investment committee. Like everyone will have a slightly different kind of balance to that. And some people will outsource more, or rely heavily on a placement agent to do fundraising activity, and some of the founders and team members are really very good at IR and good at fundraising, and so they will they'll actually be running that at the partner level. It can be very varied.
Yeah, a lot of what we see, it's a lot the founding team or the founding partners having like a major and a minor. So I think that's what we see, because I know a couple of individuals that are the perfect Swiss Army knife. They can do a bit of everything. Yeah. But on the other hand, then you rely too much on this person, and then this Swiss Army knife will get used relatively quickly. So also, that's why you need to have a let's say a good ground in the founding team to have all the skills that complement well each other. One is taking more care of IR and investments, and the other one is more taking about COO role, like internal organization and also investments. So I think usually that's how I see how they split the work.
What are the common approaches that emerging managers take to getting hold of capital?
I guess it's always been the case that there's deals to do before raising a fund, is in that there's a context for sort of pre-fund deals, and they're always really that's been often a big part of what brings new groups together. But the way that the ecosystem around groups that are purely operating on that basis, and by that I mean the growth of independent sponsors who are essentially potentially wanting to remain in that format as well.
So that's the term. Independent sponsors is the term for firms that always do deal by deal. They raise money, they do a deal. They raise money, they do a deal.
It's the sort of nicer term than fundless, because why define it by what you've not got? And certainly a lot of these groups are just not interested now in doing that.
Yeah.
I think it's also one of the contexts around why when we look at the sort of lower fundraise numbers for new funds, we don't see the full picture, because so much activity is now eaten up by direct deal doers who might have otherwise 10 years ago, 20 years ago launched a fund. It points, that's activity that doesn't get reflected in the lower numbers for this space, right. But there's still people setting up and doing that.
And there are people that choose, they don't want to fund, they're happy with
that. They choose to do it, yeah. Right. But I also think it's, any new group today, there's a pre-fund deal element at play, right? It might be executing that sort of those first deals in and around that first close, and it's sort of off we go when we're in a fund construct. But more often than not, an ability to do quite a number of interesting things, work out that team dynamic, test the thesis, but also start building your firm. These are the deals, shoot off fees, and you're in a position to sort of be in business and start to build. It's also, I think, a phenomenal way to obviously build those critical early relationships with LPs. Yeah. So you could, who may or may not be interested in a fund, and that's a real dynamic that funds should pay attention to around, in terms of the prospect of raising capital if they really want to do that for a fund. But the ability to show them things that are interesting, execute on them, essentially say, look, this is what we're going to go and do it, and come back to them. And that's how you build those long-term relationships, is you say, okay, we've seen how they've operated, and it's not that, then you kind of merit that kind of critical mass that can bring it together for a fund. Yeah. So it's always been, I think, it's a growing asset class and ecosystem in its own right, much more familiarity with it on the investor side as well. So it's a really important part of the picture. It is actually a great potential alternative for groups who just think, plenty of people I've been chatting with in the last 12 months who just think the fund model's sort of broken. They're like, well, we don't think actually the fund construct worked in terms of certain deals we didn't get to do, because it was the wrong time in the evolution of the vintage for the fund, or it was outside of a certain parameter. Deal by deal affords them a flexibility. It gives them, maybe they can just be more kind of authentic deal doers at the end of the day. But what the flip side of that is, you don't really get to scale it. No. I think if your vision for what you're building is to be sort of this sort of future brand name concept that I alluded to, but you want to basically take it to another level and hire and well beyond just this initial set team and build something that's going to outlast you, you probably need some third-party committed capital.
There's got to be a lot of frictional cost to constantly raising.
Yeah, people bemoan the sort of fundraise challenges, but like deal by deal is basically, well, go and do that every single day.
Exactly.
So it's a basic way to say, do you want to give up a year or two to just do it in a kind of isolated way and get on with it, or do you sort of want to basically try and manage a sort of IR and fundraise process around every single deal where you're sort of never quite sure who's in for what?
Yeah,
it's sort of both basically have fundraising issues. It comes down to what are you trying to build.
Kim, how do you view deal by deal, or what was the word? Independent
sponsor. Yeah, so I think independent sponsor, I think it really depends on the background of these fund managers and also the geography. The background, of course, if you were a managing partner in a very upper mid-market fund, you basically don't really need to go back. I mean, some they choose to do, but you don't need that. You raise like a proper fund. But a lot of them, especially the first-time team we discussed before, often they need to prove themselves that they can make it work, that they can make interesting deals. So they go through this independent sponsor journey with a view to raise a fund. Also, some of them, they take a bit the hybrid route. And that's actually something at Unigestion we have very good experience. It's what we call short duration fund or mini fund. So basically, it was quite. I think it was something that was quite popular over the last few years, especially because of the tough fundraising environment. Now, let's assume, I take random numbers. You want to raise a $500 million fund, invest in 10 portfolio companies. Raising $500 million is not easy nowadays, even if you have a very good track record. So I think what we approached this group was say, hey, why let's just divide everything into fund size, divide into number of portfolio, the size of portfolio divided by 2, investment period cut into, and I tried to cut the carried interest into, but I was not successful. But actually, so I think these short duration funds they have blind pool capital, but you have some element of velocity, which is a bit different. That then is the right stepstone to make it to the normal institutional fund that you initially wanted to raise. So that's one comment. And I would say in Europe, because of the independent sponsor funding is not as vibrant as in the US. For instance, in the US, we also invest quite a lot in the US. In the US, the independent sponsor ecosystem is very vibrant. You have a lot of capital to back these GPs. So a lot of them, the traditional journey is to say, okay, I do 2, 3, 4, 5, let's see, deals as an independent sponsor, and then I raise my institutional fund with institutional, because you have institutional capital backing this independent sponsor. In Europe, you have a couple of firms doing that. Also at Unigestion, we also do it, not with our emerging manager fund, but with another program. We also do that. But in Europe, I don't know if you concur, but in Europe, it's not as good as in the US.
It's definitely just smaller in terms of when you look at numbers, but the US has grown rapidly. It's amazing to see kind of where it started and just the size of that pool now, which I think is 100% being replicated here. We're just at a sort of later stage with it. So I think it's a great case study in what we've got to look forward to in the ecosystem here, in so many ways, not just in terms of the activity that it represents, but investors interested in it, the way the sort of service provider community will unite around it and be really supportive of it, and the sort of real sense of excitement around there's something a bit new here. There's not that much information about what's going on, and so it's a real sense of something quite formative for the growth of the industry at this stage. I do think it's that sort of dynamic between thinking around committed capital and fund capital down the line. My sort of top piece of advice when groups are starting out and they are being very intentional about that's what we want to do, this is just a stepping stone, is to think about the ways that you can sort of operate as if you've got a fund today, because you don't have to do quite as much. And I think groups sometimes fall over themselves by not thinking about certain things that if they instigated early on will point to them meriting it. Even things like you hear groups, an independent sponsor who was so adamant they're doing this, they were saying we're still going to structure our carry in the team in fund vintages and think about some certain fund operations pieces that we wouldn't otherwise actually need, but just so that in time we'll be able to say to the LPs, not just we merit it now because we've made great money on these deals, but we know what it means to be in the business of investment fund operations rather than just executing of deal by deal transactions.
Yes. Will we ever see another mega buyout emerging manager?
I mean, it's not every day, but you see in the US emerging managers raising above $1 billion. Still, this I think we see quite often. Of course, you don't have 20 of them closing every year, but that's what we see, and I expect to see also some inflation in terms of the target size of Fund 1, which normally was always below $1 billion, even for the people that had the credentials actually to raise more, but they always wanted to stay a bit, below. So again, I mean, multi-billion, let's see, but between 1 and 2 billion, at least in the US. In Europe, I still don't really see it.
Yeah. What's your one piece of advice to say there's a team or a bunch of deal makers that have been thinking about spinning out, teetering on the brink, hesitating? What would you say to them?
A lot of the fund managers that were emerging managers that we have backed, that have went through the pain and the difficulties to raise Fund 1, to deploy fund 1, to raise fund 2. Then suddenly you have success. You have oversubscribed fund. You don't know how to deal with suddenly you're super, you're in demand. You need to cut back investors. People start to fire back at you because you cut their allocation. I mean, to went through the full journey from ordering the toilet paper at your very first office to be sitting across, multi-billion fund and need to say no to investors that want to give you their money. A lot of them say, look, it was always a lot of difficulties, especially at the beginning. It was tough, but none of them regret. None of them regret that move. And again, to do something where they're also an owner of what they do, I think, I think I have so many good stories. Of course, you have some stories that don't go, are not so straight, but I have so many good stories that I think I would make them believe that it's the right thing to do, right?
Mm-hmm. For me, it's sort of somewhere between. There's a sort of know thyself a bit of advice that I don't know quite how to put it, and this is going to sound like awfully cliche, but they neglect to think about the sort of know the LP or know what is on offer for the LP, what this fulfills in their portfolio, what you can do for the LP in what you're doing here, and really reflect on that as part of the reason why, in terms of what's motivating you to do it, because you genuinely think you can address it. I think it's one of the things that people get wrong in that process is, they haven't done the prep to sort of even understand what the LP needs from them through the process. They don't even necessarily know who they're sat in front of sometimes. They've not done that kind of homework. But at a broader level, knowing really why this sort of deserves to exist, not because you believe it so much or because you think the market opportunity is just so compelling, but because it deserves to exist, because this is really going to fulfill a need in the portfolio of the LPs you're talking to, and bring it back to the quality of the partnership that is on offer for that LP in terms of really addressing something for them, and recognizing that these funds are partnership structure, that they are only existing in the combination.
And guys, thank you so much. What a great launch pad for FundShack's Emerging Manager series. It's been a real pleasure speaking with you both.
Thanks a lot. Thanks, Ross.
Cheers, Ross.
You've been listening to the FundShack podcast. Wherever you're listening or watching, please click follow or subscribe. That's all I ask. Thanks for listening.